Why are Treasury yields collapsing? What happened in the Treasury market this week? Hello, members and super savers. I hope you're healthy and well. We've seen some quite lackluster T-bill auction results and a decline in longer-dated Treasury yields this past week. So with all the messages that have come in from you recently, we're going to talk about the three big events that drove those Treasury yields down over the past few days. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Event number 1, the Fed skipped a rate hike. This one we've seen before, so it doesn't really need a lengthy explanation. It seems that whenever the Fed skips a rate hike, the market starts celebrating for a few days with higher bond prices and lower yields, in the hopes that this means the Fed is at the end of its current rate hiking cycle. Based on our interpretation, it seems that the Fed, even though they have now paused for 2 consecutive meetings, has actually left the door wide open to future rate hikes. From the FOMC press conference transcript, we are attentive to recent data showing the resilience of economic growth and demand for labor, evidence of growth persistently above potential, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of monetary policy. As we all know in this community, the last inflation reading in September was 3.7% on a year-over-year basis. So it seems we're not quite at the Fed's 2% target inflation rate yet. That, combined with uncertainty around economic growth, the recent events in the Middle East, and the October rise in longer-term bond yields, which have since retreated a fair bit, means that the Fed is operating in an environment of immense unknowns right now. And personally, I think it makes sense for the Fed to pause and let the data sink in. And from what we've seen, 2/3 of you feel the same way from this recent poll we ran, that skipping a rate hike this time was the right decision. Basically, I think that the market's interpretation of every Fed wait-and-see decision as the end of its current rate hiking cycle and the beginning of a new rate lowering cycle is premature. In fact, Fed Governor Powell is very clear about this.
The fact is, the committee is not thinking about rate cuts right now at all. We're not talking about rate cuts. We're still very focused on the first question, which is, have we achieved a stance of monetary policy that's sufficiently restrictive to bring inflation down to 2% over time, sustainably?
If the Fed ever changes their mind about their target inflation goal of 2%, we'll need to reassess all of this. For now, I've linked the full FOMC video in the video description below for those of you who want to watch the rest of it. So let's move on to the event that we feel really drove Treasury yields down on November 1st. Event number 2, the quarterly refunding statement that the Treasury issued was better than the market had expected. The quarterly refunding statement basically walks investors through the Treasury's short-term plans for note and bond issuance. And in normal times, it's not an event that's really in the limelight. In fact, drop a comment below if this is the first time you've heard someone really explain the Treasury's quarterly refunding statement. In any case, the Treasury's quarterly refunding statement is in the limelight now, given our growing budget deficit and the heavy government borrowing that's needed to fund that growing budget deficit. Here are the major points from that statement that the bond market celebrated. First, the Treasury is increasing the size of the refunding auction this quarter by slightly less than major dealers had expected. That's for October, November, and December. A refunding auction is when the Treasury issues new debt to refund Treasury notes and bonds that are maturing. So in this case, the Treasury announced on November 1st that they would be offering $112 billion of new Treasury securities to refund, to pay back basically approximately $102.2 billion of privately held Treasury notes maturing on November 15th, 2023. Privately held Treasury notes means Treasury notes that are held by financial institutions, other private companies, and people like you and me. And if you're wondering about the difference between the $112 billion in new issues and the $102.2 billion in repayments of maturing debt, This $9.8 billion difference is the actual net new cash from private investors for the Treasury, which of course gets added to our ever-growing outstanding national debt pile. And what some of the major dealers, the market, was celebrating was this $112 billion number. Why was the market celebrating this $112 billion, Jen, you might ask? Well, because what the market had expected was that the Treasury would issue $114 billion of new Treasury securities in this quarter. And what the Treasury announced was that they would only need to issue $112 billion of new Treasury securities this quarter. Never mind that this $112 billion, it's already $5 billion more than what was issued the previous quarter. So in a nutshell, the Treasury still has to raise more money than in the previous quarter, but the market is happy and celebrating that it's less more than they had expected. And yes, teachers and grammar gurus, I know that less more is not proper English. But when folks ask us the question, but the government is still raising more debt, the answer everyone seemed to understand best was yes, the government is still raising more debt, but it's less more than the market expected. And do you know the two main reasons why the Treasury is able to increase their debt issuance this quarter by less more than expected? Here's what happened. And both reasons sound more like lucky circumstances from a deficit point of view than any structural shift for the better with our nation's finances. 1. More revenue is coming into the Treasury this quarter than expected, mainly from California and other states who had their 2022 tax deadline partially extended due to natural disasters, but have to pay up now as these extensions are expiring. And 2, Congress hasn't approved any additional spending recently. Nothing for Ukraine and nothing for Israel. In fact, Congress hasn't approved much at all recently since we didn't have a Speaker of the House for 3 weeks and weren't able to pass any new legislation. As I mentioned earlier though, both of these are one-off events, meaning that they're unlikely to happen again before the next quarter's refunding auction. The second major point from the Treasury's refunding statement is that the Treasury predicts it will need to increase the planned amount of Treasury sold just once more at the next quarterly refunding auction in February. The implication here is that after one more last increase in February, the refunding auctions will have reached a steady state sustainable level with no need for further increases in overall issue sizes. Because the market had predicted that there would be at least another second bump needed at the May refunding auction, it took the need for just one more increase in February and not two in February and May as a good sign, and continued celebrating even further that the Treasury needs to raise less more than they had expected. It seems the market focuses on the less part and we pay more attention to the more part, which brings me to the third major point from the Treasury's refunding statement. While the Treasury plans to gradually increase the auction sizes of their Treasury notes and bonds overall, the increase in auction size will be at a more moderate rate for longer dated tenors, meaning longer dated maturities. Here's what the Treasury means. This column shows the month of auction issuance, and these columns show the auction volume in billions of dollars for the different maturities. FRN stands for floating rate notes. This row shows the total auction volume for the third quarter for the different maturities. And this row shows the total auction volume for the fourth quarter for the different maturities. The numbers that were just announced in the same November 1st Treasury refunding statement that we're discussing. And this row shows the quarterly increase in auction size from Q3 to Q4 for the different maturities. What the Treasury has done is essentially pump up the auction volumes significantly more for the 2-year, 3-year, and 5-year notes than it has for the other maturities, with no increase in auction size at all for the 20-year bond. In my mind, these numbers are actually a bit concerning because what they show us is that not only is the government borrowing more to fund its growing deficit, it's also funding more and more of that deficit with shorter dated debt, which may get more expensive when or if rates go up, depending on your perspective. And most of the Diamond NestEgg regulars know what I think about that. Plus, these statistics also don't include short-dated Treasury bills whose issuance has basically doubled year over year as of October, as you can see from this green bar here. Clearly, though, a smaller planned increase in auction size for longer-dated maturities contributed to why yields on the longer-dated Treasury notes and bonds have fallen so much more significantly than the shorter-dated ones. Plus, the fact that the longer the time to maturity, the more sensitive a bond's price generally is to interest rate and other market movements. The other interesting thing to keep in mind is that the 10-year Treasury, the auction size of which has been increased very modestly relative to the other maturities, as you can see here, the 10-year Treasury is the benchmark from which many other rates are derived, including those for mortgages for people like you and me. So, keeping this benchmark rate relatively stable, or rather not letting it run much higher than current levels, is something that would be welcomed by a lot of parties, including the agencies, municipalities, and organizations that need to issue new debt. And as if the quarterly refunding statement from the Treasury were not enough, then came the third major event of the week on Friday that drove Treasury yields down even further. Event number 3, the jobs report, showed job growth slowing more than expected. According to the Bureau of Labor Statistics, total non-farm payroll employment increased by 150,000 in October, well below market expectations of 180,000. This gave the bond market another reason to celebrate and push yields lower, because slower job growth may indicate a cooling economy, that the Fed's rate hikes are indeed working, and that there won't be any need to raise further. Personally, I think the jobs report was the only event that should have been somewhat celebrated. But even with that, it's too early to tell.
A few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal.
So, to summarize, why did bond yields drop so much? Well, apart from all the reasons I just mentioned, because sometimes when all you've had is bad news for a long time, you want some good news. And the bond market wants some good news right now. They want to hear that the Fed is done hiking rates, because the bond market has suffered massive losses since the Fed started hiking rates in early 2022. In fact, according to Reuters, bond fund managers are heading for the third year of losses for the first time in decades. And bond markets do not want to hear that the committee is not thinking about rate cuts right now at all, even though Fed Governor Powell has said
The committee is not thinking about rate cuts right now at all.
And maybe that's why bond markets didn't watch, or they chose to ignore the parts of the FOMC meeting that I shared with you, and why they focused on the less part of less more debt than the more part. Who knows? Everyone's financial journey is different. As I've mentioned in these recent videos, all of which I've linked below, the markets are nervous right now. And just as there will be weeks when bond yields surge like they did in October, there will also be weeks like the one we just witnessed. Now, I'm sure some of you are sitting there wondering, what now? Here's the thing. If you're holding to maturity, all of these events from this past week, it's just noise. Because when your Treasury securities mature, you'll still get back the interest and principal repayment that's owed to you, assuming that our government does not default, which is my ongoing assumption. And if you're laddering shorter maturity T-bills in particular, those rates are currently still relatively stable, as you can see here. If, on the other hand, you're planning on picking up some longer dated treasuries in the near to medium term, then stay tuned because, well, let's just say our next video will be made especially for folks like you. It was originally a part of this video, but it's such a good one, it really deserves its own glory. And remember this Treasury auction table we talked about earlier, because we'll be coming back to it in our next video. So, how are you feeling about bond yields after a week like this past one? What are some of the questions going through your mind? Drop a comment below and let everyone know. All right, members and super savers, as always, I hope this video cleared up some of the confusion and nervousness around the drop in bond yields this week. And as always, if you enjoyed this video and learned something new, I'd love to invite you to continue to support our channel through membership so that we can keep producing one-of-a-kind, objective, sponsorship-free videos for you and for our super saving community. Come for a chat at our next live member Q&A on November 17th at 5:30 p.m. Eastern Time. And check out our latest member videos. Take a look at this video here to learn more about Diamond NestEgg membership, or visit our channel page or the join link in the video description below. See you again very soon with more brand new wealth building content for your financial journey.